Hi, I'm Atika. Have you ever heard of common stock? What actually is common stock and why it matters to investors? Common stock is a type of security that represent ownership in the company and able to claim part of the company's asset and earnings.
First, how to differentiate the stock from others? It gives a substantial return. Common stock has the highest rate of return and not fixed. It has high risk, high return. However, the priority to claim dividend was put the last after debtor and preferred stock. Voting right permitting stockholders to vote for major matters such as electing member of board of directors. The stockholders' liability is limited to the amount of their investment. Common stock also gives preemptive right, which allow the right to purchase new shares issued by the company.
There are different types of common stock. First is growth stock. It is a stock that is expected to grow in future at such high rate. Long-term investors are usually interested with the stock based on the company's positive performance due to its sustainable positive cash flow. The stock price usually volatile. Next is income stock. It is stock that pays steadily increasing dividends. The stock price has low growth. Blue chip stock is stock issued by huge and well-established companies like Amazon and Boeing Co. The company performance can impact the economy of the region and they must be dominant in the industry. The company's stock price is usually cheap, less volatile, and has acceptable amount of dividends. Cyclical stock is a stock that fluctuates based on the business cycle. Investors will be drawn to the stock when the economy is strong and steady. Defensive stock is a stock that remains stable even during economic downturns. The example of defensive stock is in the industry of necessity goods such as drugs and food and beverage. Speculative stock is a stock issued by financially unstable and uncertain future company. The stock usually issued by small company or new industry. The riskiest stock to be invested. Lastly is the tech stock. It is a stock from technology industry. It has considerable risk and huge returns. The investor who can tolerate the risk will tend to invest in the stock as it is profitable if the risk was managed.
But why common stock? The advantage of common stock is its substantial return, high return, long-term, and able to maximize profit of dividend based on investment. If the return exceeded the amount invested, it is considered as capital gains. The liability carried by the stockholders are limited. Any financial failure will be beyond amount invested by the stockholders will not be liable for it. Besides, the liquidity of the stock makes it easy to buy and sell at any time as it is fairly priced. The cost of each share is also bearable among investors. The information dissemination is an assist investor to make a decision. Stocks are able to hedge against rising price due to inflation.
The disadvantages of common stock is that the stock risk and concerns are based on a business, financial position, purchase power, market behaviors, and event risk. It affects returns on investment. The volatility and no guarantee make the common stock able to garner high profits or great loss. The investment risks are greater as it depends on the market condition. Thus, it's high risk, high return. Apart from that, stockholders will have the least priority for dividend and be paid with excess profits after net income, after interest and tax. If the company got into liquidation, the stockholders will be the last to claim the company's assets after creditors.
Risk can be a disadvantage to the investors, but manageable. Business risk is referring to the level of uncertainty of the return on investment and its earning by the investors. Financial risk is the uncertainty of the company's financial position due to its debt-equity ratio. More debts means higher risk. Market risk, which also known as systematic risk, is the risk of stock market directly impacting all the securities and the financial markets. It could also cause value of stocks drop significantly. Purchasing power is a risk that depends on the inflation and deflation of economy. The rate of inflation can affect the return on investments. Interest rate also considered as risk as the changes of it can change the value of common stock and bonds. Liquidity risk is inability to liquidate an investment easily and at a fair price. Event risk is unpredictable event that shock the entire stock market and drastically and immediately affect the stock prices. Clear example, when MCO was firstly announced by the Prime Minister, the FTSE Bursa Malaysia KLCI index dropped more than 30%, which is the most drop in the history of Malaysian stock market.